And now for something completely different.
Forget everything you've been told by others before.
There is a niche. Niche? 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 Niche. It's a niche.
I don't know.
It's a niche. The niche. It's a special area. There we go.
Get ready for the real deal.
Most important question, Lance.
Yes.
Pineapples on pizza or no?
The full story.
Me personally, if I'm going to eat a pizza, it's going to be a pizza.
I'm not going to order pineapples on a pizza, but I'm also not going to chastise somebody for doing it because I really don't care. Do what you want to do.
The whole enchilada.
So when you eat chili, beans or no beans?
No beans.
It's money news and information you can use to grow financially healthy, wealthy, and wise.
Your Excel Word example. It's a great example, right? Because there's Google Sheets, which does
Lotus.
Word.
Lotus 1, 2, 3.
Loaded. Okay, boomer.
Now, welcome in The Real Deal, the real investment show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. Of course, the second best day of the week. It's Thursday as we get ready to wrap up this first trading week of March. And pretty soon it's going to be Christmas. So it's just going by quick. I mean, it's just like, it was just the other day, it was New Year's, and already it's my kids are like, where are we going for spring break? So anyway, this is where we are. Time's flying by. So a couple of things, of course. Yesterday, now, of course, all the headlines now are just what's happening with Iran, of course, and that's really taken the kind of the general headlines. But a lot of good news underneath the surface yesterday, economically, that nobody was talking about. ISM Services had a very sharp jump yesterday, and that it follows ISM Manufacturing on Monday, which moved back into expansionary territory. So we're seeing a good bit of activity happening economically. ADP also reported employment numbers yesterday, 63,000 jobs, much stronger than expected. So we're certainly seeing a pickup in economic activity, which is good, right? I mean, that's helping support, markets and earnings and those type of things. So, despite what's happening with Iran right now, you're seeing a lot of pickup now in economic activity kind of across the board. So again, that is supportive and something worth paying attention to. Kind of those headlines get buried when everybody's kind of debating on, everybody becomes an energy and Middle East expert whenever something goes on. So that's all everybody's talking about. But the underlying economic data continues to improve, and that is supportive for the market. So, this just kind of keep a watch on the fundamentals that kind of drive things ultimately. Now, now buried inside that ISM Services report was ISM Services Paid, which actually declined a bit. So we saw an increase in activity, but the actual prices paid inside of services declined. Now that's important because services make up about 75% of the current economy. So much more, while we see prices paid rising in the manufacturing space, that's due to, people running up the prices of commodities. We're seeing the services prices actually declining. And again, that's a much bigger weight overall. So that's going to help kind of keep, inflationary pressures at bay to at least some extent right now. So again, some of this impact we're seeing of higher oil prices temporarily, and again, as we talked about the other day, the sustainability of higher oil prices. So right this morning, oil prices are trading roughly about $77 a barrel, up a little bit. But we need to, if we sustain that level for a while, that will feed into, because energy is used in everything that we do, that will start to kind of feed into some of the inflationary data. So again, it's worth paying attention to, but it's going to be the sustainability. If it stays here for a while, that's going to be problematic. If oil prices decline pretty quickly back into the 60s, then it's not going to be a problem. It just depends on how long they're here and how it affects the transition of those higher oil prices through the economy. But kind of keeping a watch on those things is important, because again, that's going to impact other areas of the markets that are going to be important as we start to move forward. Interesting enough, a lot of money's been chasing international stocks this year, and it was interesting this morning that China came out and actually lowered their growth rate to the lowest rate seen since 1991. So a big decline in economic activity. And again, they have lots of concerns. They're running a 4% deficit to GDP. Economic growth is slowing. They've got problems in their housing markets. They've got problems in liquidity. So, a lot of the things that, we talk about, here in the U.S., like, oh my gosh, this is the U.S. People are chasing other areas of the market that have as much problems, if not more, than the U.S. So kind of jumping out of the frying pan into the fire, so to speak. Again, another concern, a good example of this, another concern is the market cap weighting of the top 10 stocks in the S&P 500. Great chart out this morning. I posted this on X. But if you take a look at the top 10 holdings of most other countries, ex-Japan, the U.S. has about the third lowest market concentration risk of every country in the rest of the world. Every country, starting from Brazil to emerging markets to international markets, all have much higher market cap weightings for their top 10 stocks than the U.S., which I thought was interesting. From all the headlines that you see, it's like, there's this big market cap risk in the U.S. It's everywhere. It is literally everywhere right now. And again, be careful you don't jump from the frying pan into the fire over some headline that you see. Make sure and do the work, do the analysis, so you know what you're getting yourself into. Yesterday, so let's talk about what you need to know before the bell this morning, because again, this was the kind of the big story yesterday morning. We talked about yesterday morning that the market, had broken below the 100-day moving average. That was kind of key because we haven't broken the 100-day moving average and closed below it in a long time, since last April. So we broke that. And we talked about yesterday that, be careful, don't knee-jerk react to that, don't sell out of the market, because again, there's a lot of buyers sitting down here looking for these opportunities. And we saw that yesterday. Markets climbed back above that 100-day moving average, so that break has been negated near term. We're still working below the 20 and the 50. Now importantly, we have the 20-day now trading below the 50-day, so that's putting downward pressure on the market. So just because we recovered that support level yesterday, we're not out of the woods just yet, because we do have this pressure that's sitting on top of the market. We're also on a sell signal. Relative strength is still decently oversold, but trying to turn up here. But that action yesterday was very positive. So if we can get some follow through today and get this market back above the 20 and the 50, then potentially we're going to be in a better position. Now, one thing that's going to help fuel this is there's a couple of things that are going on. First of all, we've got a huge short position against stocks right now. Also, put buyers have been very aggressive in buying puts. We have a very large level of puts sitting out there, which are fuel for a rally, because if the market starts to rally, they've got to cover those shorts, and they'll close out their puts and they'll flip to the other side. So that's going to start to cause a push in prices if markets move up above this 20, 50-day break. Right now, all the algorithms are looking at this 20, 50-day moving average as resistance. We keep fighting that. We've been fighting it here for a while. But again, if we can move above that, by tomorrow, Friday, close out the week by Friday, that would be a better bullish setup for the markets. Near term, we're still kind of in no man's land. We're sitting above support, but we've got this kind of pressure sitting on top of the markets. And we've talked about this for a while, is that, in fact, this is kind of what we wrote about in last weekend's newsletter. We talked about this topping process that, we just kind of see, we have these rising tops, and now we have this kind of declining set of tops in markets. Even though we've got good support along this bottom, we have this compression in price. And so again, the pressure's to the downside, not the upside right now. Now, interestingly enough, Citadel just came out with a report this morning. Retail buyers were in this market heavily over the last 2 days. In fact, there was record retail buying of ETFs, largest in like the last 5 years, over the last 2 days. So there's been retail buyers have been the support for the markets, and particularly they've been the support of the markets over these last 2 days, in particular buying ETFs. Yesterday, we saw software stocks doing well. A lot of these really beat down sectors did very well yesterday. Energy, which has been the leader because of what was happening in Iran, actually was the worst performing sector yesterday as well. So again, pay attention to what's going on here. Markets are fine. We're in this neutral no man's land, so don't make any big bets right now. We still have risk to the downside that we could break lower, and you want to be aware of that. But there's also the potential we could break to the upside. So again, just be careful here until this market makes a declaration as to where it wants to head to next. Okay, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. All right, so a couple of things kind of going on here as I talked about. There's a lot of economic activity that's been happening, economic data that's been working behind the scenes, which are certainly much more encouraging. You know, we'd seen this kind of slowdown in economic data heading into last year, particularly at the end of the year, and then kind of coming out in January, it was still very weak. And especially on the employment front, we're starting to see a good bit of improvement. So this is going to be interesting because, and again, we'll Michael, this is a good question for you. As we're starting to see this improvement in economic activity, particularly on the employment side, again, assuming that ADP kind of leads on into, an improvement in the BLS reports, this is going to start to put the Fed in a little bit more of a box about potentially cutting rates. And we're seeing expectations for rate cuts this year starting to drop here. We're down to, I think, under 2 rate cuts for the rest of this year at this point. But that, the rate cut, the monetary accommodation, that's been a big driver for stocks, particularly last year, is these expectations the Fed was going to continue cutting rates this year. But if the economic data continues to improve from here, that's going to lead to some pressure on potentially, maybe not raising inflation much, but it may keep inflation from coming down much more if we start to see this kind of growth picking up under the economy, which may set the Fed on the sidelines, at least temporarily. What do you think?
Yeah. So I think first of all, it's all priced in, right? Everyone, the market's pretty much priced in 1 rate cut for the year and not much next year either. Even Stephen Moran, who wanted to cut by 50s at the last couple meetings, has tempered himself as well and saying only 3 rate cuts for the rest of this year. So, first of all, I think the market's expecting it, but I think, at the same time, while economic growth is showing a little bit of life, right? ADP is still only, 63 yesterday?
Yeah.
The economy is growing by 150,000 jobs or so. So it's still underwhelming. But, there are signs of some optimism. We'll see how this whole tariff thing kind of prices into the surveys. I think it's too soon for the latest round of surveys to reflect it. But we'll see if that changes the behaviors of some of these manufacturers, of some of these service companies. But it is, I think the important takeaway is that it felt like the economy was declining, and now it's at a minimum stabilizing and possibly showing signs of growth. But then, of course, so like I said, we, on top of the tariffs and the Supreme Court decision, now we have higher oil prices and some unease because of what's going on in Iran. So, it's always something.
Right.
But to your point, I think, the very front end of the curve is stuck where it is. The Fed's not going anywhere anytime soon. And I think both the Fed and everyone recognizes that. So the question is, what's going to happen with other yields? And we've seen the longer end slipping a little, coming down in yield. So we're seeing that the yield curve flatten up a little bit. It's gone from 75 to the low mid 50s, and that becomes restrictive. The bank's profit margins are predicated in part on the shape of the yield curve. So the combination of yields stuck where they are, not coming down, and the yield curve flattening a little will, on the margin, weigh on economic growth too. So there's a lot of things on our scale that are kind of tipping it up and down that we need to keep an eye on.
Right. And again, this is what we always talk about before, is that, markets are doing their thing, and we all get tied up into the market's doing this or the market's doing that. And, when markets are doing very well, we kind of ignore risk. And this is what we talked about before, is like all it takes is some event to come up that kind of undermines that general thesis. And that's what we've been working with really kind of since the beginning of this year, is that last year, AI was the thing and everything is great. And this year it's all been this conversation about, well, will CapEx actually turn into revenue? Of course it will. But right now we're just going through this whole kind of debate on the issue. And then you have this issue with Iran pop up, and that causes higher oil prices. That weighs on other areas of the markets. And this is when we talk about risk management so much, is that it's easy to get, into the markets. When markets are doing great, it's just easy to buy stuff that's going up, which is fine. But you've always got to be aware of these unexpected events that come along that cause a potentially, and it hasn't happened so far, but something like a military operation in Iran could have upended the markets a whole lot more in theory. And if you kind of go back and look at previous wars over time, the general kind of decline in markets run 6 to 11% ish. When the war first starts. And then once you kind of get through whether it's a military operation or an actual conflict, once you kind of get through that initial phase, the markets absorb that analysis, and then markets start to recover and move higher from there, because war is good for economics. But we didn't have that happen this time. But those are that's when we was talking about managing risk, because you never know when you're going to wake up on a Monday morning and something's occurred over the weekend that undermines that whole kind of thesis that previously existed. Oh, markets are fine, earnings are fantastic. Something happens over the weekend, all of a sudden markets are repricing earnings expectations very rapidly to the downside, and then having to reprice markets because of that.
Yeah, I think what's difficult is that these narratives work both ways, and they're very easy to buy into. They on the surface make a lot of sense. Mm-hmm. And we, two of us who have been doing this for 30 something years still get caught up in them. I think we've hopefully over the 3+ decades, we've learned that we research them, we understand them, we understand that they are what's driving the market, but we're better about not letting them just immediately impact our decision making. Mm-hmm. But I think for the large majority of investors, especially retail, that don't have experience, narratives are what's going to drive the themes. And there's all kinds of narratives out there. I was just reading there's a Bloomberg article out there, I think it was from yesterday. Iran war oil shock threatens to unleash wave of global inflation. So, what is that? That narrative sounds logical, right? If we're going to be in a battle with Iran and oil is going to keep going higher, surely it's going to cause inflation, right? Mm-hmm. Because oil is part of CPI, and if oil goes up, then CPI goes up. But it fails to capture certain things. And we've talked about this before when various other spikes of oil. When the price of oil goes up, we spend more on gasoline and heating our house. That means we have less to spend on other things. So yes, the price of gasoline may go up, and yes, it takes a bigger chunk of our wallet to pay for the gasoline, but we're gonna save by buying less of something else, whether that's new cars, whether that's Cheerios, whether it's going out to dinner or the movies or whatever it is. That's, so there's a negative price impact on some other part of the economy, and there's also a growth impact that's costing companies more money to heat their buildings, to fuel their trucks, their cars, whatever it is. That's going to hurt profit margins. They're going to lay off people. Consumers won't spend as much, like we said. So there's this give and take. And yes, the narrative may be true that if oil stays high for a while, months, not a week or two, then yes, the economy may suffer, and yes, inflation may rise. So, yeah. But when we talk about the Fed, and the way, how do we look at CPI? Or how does the Fed look at CPI? They always look at core CPI, excluding food and energy. Mm-hmm. because they know that food and energy are volatile. And a lot of times their price has nothing to do with the economy. It's the weather. It's what's going on in Iran. So keep in mind, the Fed's not looking at this and saying, okay, gas is up 10, 15% over the last week or so. We're going to have to raise rates because this is very inflationary. In theory, this is having little impact on core CPI. Some of it does leak through to CPI, to core CPI, because there's gas in just about everything.
Right.
But again, we need sustained oil prices to, I think, really have an impact on both the economy and CPI.
Yeah. And you just let me know how old you are by talking about Cheerios. I've never heard anybody wake up in the morning and go, Cheerios are delicious. So, at least your heart healthy, right?
There you go.
Yeah, first thing I want to do is open up a box of Cheerios in the morning.
First thing that came to my mind.
Yeah, I know, right? You know what my wife's favorite cereal is? Still to this day. And I'll catch her in like the pantry. Lucky Charms. Really, it is the weirdest thing. I love my wife to death, but that's everybody has these little weird things. That's her weird thing.
Well, they are magically delicious.
They are magic, but she'll like go in and she doesn't eat cereal with like milk.
Yeah.
She just sticks her hand in the box, gets a handful of the Lucky
snack.
No, yes, that's her snack, and she'll just it's her own box. Nobody will touch it because she sticks her hand in there. But yeah, it's pretty funny. So we you look at our pantry, it's like it's Raisin Bran. Yes, there's a box of Cheerios in there because they're delicious, and then the box of Lucky Charms.
Yeah,
so
my wife's a Cheerio person too.
Your wife's a Cheerio person?
Yes.
Me not. I am not a Cheerio person.
She likes it with sliced bananas on it.
Well, that's pretty traditional.
Yeah.
Yeah. Throw some peanut butter in there. And, you got an Elvis Presley going on. Anyway, all right. So, Mike, let's talk a little bit about, you wrote an interesting article on Wednesday that is interesting because, this has been one of the theses for a long time in the market, which is just buy and hold, buy an ETF because ETFs are passive indexing. And I've argued this case for a very long time. And you'll hear a lot of, financial media. They'll say, investors are passive investors. They just buy ETFs. And, in thesis, there was some correctness to that. Right? Instead of buying a mutual fund, people used to buy a mutual fund with an active manager. So you bought the Peter Lynch Fidelity Magellan Fund, right? And you had great performance over the years, and he was actively managing the stocks in that mutual fund. And then turn of the century, people don't remember that prior to 2000, there were 3 ETFs. There was the Spiders, the Diamonds, and the Qs. That was it, right? So, and there used to be, when I was first doing radio with Brent way back in the day, they had this guy named Nate Eisenberg. That's right.
Yes.
So Nate Eisenberg did this afternoon drive time show at 4:00. And so people are driving home from work. He's like eating a sandwich while he's on the air. Literally eating a sandwich. But he was always bashing financial advisors. And he was like, why do you have a financial advisor? Just buy an ETF. Well, there are only 3 ETFs to buy. There were Spiders, Diamonds, and Qs. That was it. But that was his
Triple Q was his phrase.
Yes. And that was all he promoted all the time. Yeah. It was hysterical.
Triple Q and pastrami.
At the same time. But it was interesting because it was just, this idea was to buy these ETFs. They were cheaper in operating expenses, and you're just supposed to buy and hold them, right? So you just buy the S&P 500 and you never sell it. And then, of course, today we have more ETFs. We had 1,000 ETFs issued last year for all different types of things. Of those 1,000 ETFs, over half of them were leveraged long or leveraged short ETFs. So again, giving people the ability to take on even more leverage into the markets. And so I think this brings up the argument that I've had for a long time is that, when investors buy ETFs, they're not really passive. They're just active in a different form. People talk about, I'm a passive investor versus an active investor. Well, if you're buying and selling ETFs, you're just an active investor in a different form. You're just buying baskets of stocks rather than doing stock picking, which kind of undermines the whole thesis of passive investing and what it was thought to be and what's been discussed over time. And this is why when we take a look at performance of individuals relative to the market, they wind up underperforming so much over time because they do exactly the same thing they used to do in stocks. They just now do in ETFs, which is they buy what was hot last year, which is now not hot this year. And then so they wind up chasing kind of the wrong baskets, or they've got too much turnover in their portfolio because they're chasing returns, or they're making emotional mistakes and selling or buying at the wrong times. They've just moved their passive activity into a different active state.
Yeah, so this is kind of what led me to write the article. It's really bothering me is that everyone is out there saying that the rise of passive investing is becoming more and more popular. And it's at the same time, how many of these Thursday discussions have we had, or every day during the week, where we're talking about rotations? They're moving from tech to staples. They're moving from growth to value. They're moving from small cap to large cap. The mega large caps are doing much better than the mid caps, right? It's all these rotations. And when we talk about it, when everyone else talks about it, they're talking about these rotations occurring in ETF space. So it really led me to really just think about it and appreciate that while the trading vehicle, the securities, the stocks themselves are meant to, in some cases, meant to be passive instruments, it's not really what instrument you use, it's how you use it. And we've just been seeing incredible flows going back and forth in these huge return differentials between stocks that it's not common for them to diverge that much. So I thought it would be helpful to write an article on it and better articulate kind of what I was thinking. And, I kind of hint at Bogle, John Bogle, who started Vanguard. He was the first, not started Vanguard, but he had the first mutual fund, S&P 500. He's called the father of indexing. And in the early 90s, when SPY, which was, I believe it was the first ETF, came out, he basically warned that the ability to sell or buy intraday is going to cause passive investors to become active. And, here we are 30 years or so later, ETF or SPY came out in the early 90s, and that's exactly what happened. That a lot of people think they're passive because they only own these diversified indices of sectors, stocks, factors, but they're trading in and out. They're flowing with the narratives. Everyone's flocking to value now and shunning growth, right? That's been the big one. So, it's just important to realize that the market's not as passive as it was. And so the question is, or as it's portrayed to be, and the question is, so why do we care? Who cares? Well, the answer is the more actively passive or passive aggressive, as I titled the article, it gets, the more opportunities there are to benefit from rotating between all these different stocks, sectors, factors, indices, countries, even asset classes. So, we talk about it all the time, but it's a strategy that has become a lot more valuable. And I think people need to understand why it's become valuable.
Yeah.
And
that's yeah, and no, you've got a good chart on this too, showing this in the article. There's a chart of, and it's something that we've talked about here a lot on the show, Mike, is this rotation from value to growth and growth back into value. And there's almost a near perfect non-correlation between those two indexes. So if you can determine basically when to switch from passive, from value to growth and growth back to value, it's been a very good winning strategy over time, and it's just a function of trying to get those rotations right. But again, this is to your point, the market's just now rotating, and within the markets, there's just this rotation of assets, and these rotations are much more rapid these days. It used to be a rotation would take several years to go through the process. Now it's happening in days, weeks, months, right? And we see these very rapid rotations. But this is just because money's just chasing these assets, and as money piles in, this kind of active space in ETFs is now causing these rotations to occur much quicker.
Yeah, if you just look, you showed the graph of the S&P, kind of that curving top.
Right.
But if you really look at it, it's been between 7,000 and 6,800 since early December, late November, and it's really gone nowhere. But if you bought value December 1st and sold growth, you've done really well. If you loaded up on mega cap growth and sold value, you did poorly. So again, the market doesn't have to go anywhere for you to benefit. Lance, just a little side note, when you were showing that graph
Right.
earlier before the bell, I was looking at it, and you can't even it's the volatility has been so low that you can't even see where the whole Iran thing started.
Right.
You kind of look at it, and there was a big drop on February, I think it was like 12th or 15th.
Right.
That was bigger than anything we've seen in the last week. So it just shows you, even with all the hype and hoopla around Iran, the market really, it feels very volatile. And I think some of that is because what we're seeing in bonds, in gold, in oil, especially oil prices, the dollar. But stocks they've really gone nowhere this week. And it's pretty remarkable given it's a pretty big event that happened. But it's just the market we're in. It's in a very comfortable range.
And but this is a difference. This was a chart out by Citadel Securities this morning, actually. And they did a report yesterday talking. Citadel Securities is a massive hedge fund. And they clear all the trades for, basically they pay for order flow from a lot of these online trading platforms like Robinhood. So where all the retail traders kind of exist, they have that direct data because they're buying that order flow. So when you place an order on Robinhood then sells your order to Citadel Securities, who then executes it. So that payment for order flow is important because that's how Citadel Securities sees what the retail investor is doing. And what you'll notice, Mike, is that over the last couple of days, in particular the last 2 months, there's just been a massive amount of retail buying in the markets. In fact, it's the highest level that we've seen in 5 years. But retail investors have been in here very aggressively buying the markets. And to your point specifically, here's a chart of the ETF share volume that has been trading. And to your point, you would expect that this issue in Iran would cause a sharp sell-off in the market. But in reality, retail investors have been coming in, just piling into ETFs. And we saw this yesterday. We had the market sell off on Monday over this initial kind of wave of strikes in Iran. We were down 2% at the open, rallied back to positive at the end of Monday, and then we climbed back above the 100-day moving average yesterday. So, despite what's happening overseas and despite all these concerns, retail buyers are very aggressively buying markets, and they're putting money into the markets. Every dip, they're stepping in, and they are basically the buyer of the market right now. So it's pretty incredible.
Well, I would add to that, they're trading the market too.
Sure.
Right? It's not just purely net inflows. It's just, you just showed it there, the volume graph.
Yeah.
They are trading the markets. They're aggressive, or, not recently, but prior couple months, aggressively selling mega cap growth, buying value. So again, it's this rotation and this, yes, they're buying a market, but they're trading. I think it's more important to note that they're trading the market very aggressively. And we know that they're chasing narratives.
Oh, yeah.
Their narratives build, they get chased, and then they fade away. And that's what's been going on, but just on such a fast scale that it's kind of breathtaking. And what makes all that notable, the two graphs you showed, is, again, just looking at the S&P 500, it's gone nowhere. So there, you have this placid surface and incredible churn just underneath the surface of the market.
No, and it's true. And look, if you just take a look at, and there's a lot of people in chat right now talking about, this kind of volatility chop in the market is great for options trading. And they're right, it is. You need to make options trading work. You need volatility. In fact, this month in March is going to be one of the largest options expiration days, basically in recent history. It's going to be absolutely huge. But this is also a big change in the market since 2020 has been this explosion in retail in particular now trading options. And it's been an easy market to trade options in. Markets just kind of go straight up. If you have a decline, markets get bought, you get bailed out of a bad options trade. And that's all been good. Now, eventually, someday that's not going to work. And as is always the case, option trading winds up to be not lucrative at the worst possible time. But, for the last couple of years, it's been absolutely just easy to trade. It's been a great market. It's been low volatility. You have volatility, good sector rotation. Those are the type of things that make option trading very easy and makes everybody a genius trading options. But, this is the market we've developed. Now, again, how this eventually works out, I think is going to be fascinating to watch. I think we'll be looking back at this in, 3, 4, 5 years going, yeah, that was kind of obvious that was going to happen. But, for right now, it's just fascinating to watch.
Yeah, and you know what? It's not surprising. We've become, ever since the pandemic, much more speculative society, right? Look at sports betting. Look at like the Kalshi type event betting. It's just off the charts, the amount of revenues or the amount of trades or bets or whatever you call it that are occurring on those websites. Zero DTE options, right, is half the option value. Leveraged ETFs. I mean, it's just the markets have always been speculative. I'm not going to try to deny they weren't, but it has become, I think, almost speculative to the point of betting, where for a lot of people, a 20, 30% return, gain or loss, is not a big deal, right? 40, 50%. So, if you're doing zero day options, you're really looking at binary type results. Win it all or lose it all, like a sports bet. So, that's the environment we're in. And the question is, what, if anything, will break it? Or, if we stay in this chop, if we just chop between 7,000 and 6,800 for another year, will retail investors get bored? Will they go to Bitcoin? Will they go to
Poly
sports?
market?
Will they go somewhere else?
They'll go to Poly market or Kalshi.
Exactly. So, I think it's a pretty incredible market. Just the lack of volatility with the incredible volatility just underneath it.
Mm-hmm. Yeah, no, it's and this has been such an easy. As again, you and I were having this conversation yesterday, right? So markets are off, 1-2% from their about 1.5% from their peak this year, and our portfolio is basically sitting at all-time highs. And what I found, what you and I were discussing is that's fascinating because we haven't really done a whole lot. We just have a good mix between value and growth. We've been holding on to our core positions, kind of clipping coupons. And, it's because of this internal rotation that, one day, one sector of our portfolio does really well, the other side not so much. And then the next day, the side that didn't do well yesterday is doing fantastic today, and the other side not so much. And this just kind of this grind over time has made it if you're on one side of the coin, you're either having really good days or bad days. But with this kind of, what's been fascinating with the portfolio is that watching how this portfolio has played over the course of the last several days, and particularly with what's going on, with Iran and the news headlines and everything else, is that if you had turned everything off and just looked at the portfolio, you would assume that nothing was going on.
Right. If you look at the bottom line, it's fine. And, how many days have we had where we have about 25 stocks or so in our equity portfolio? How many days have we had where there's about 4 or 5 that are close to flat on a day? Everything else is up or down by 1% or more. Like it's, you have 7, 8, 10 stocks that are up by more than 1%, another 7, 8, 10 that are down by more than 1%, a couple stocks up 4 or 5%, 1 or 2 maybe down 3 or 4%, 5%. But again, it just all kind of nets out. It's just diversification in this kind of churning market while we're leaning, right? We certainly leaned into value going way back in November, December.
Right.
And we've started to kind of lean back out of value, but not really go into growth, take some profits. And again, that's where that rotating really can both buy you the diversification because you understand that's what's going on, but just help kind of steady the boat in these kind of crazy markets.
So, we talked about, a few days ago, you and I were discussing, fixed income and bonds in particular, and I talked about on the show that yields had gotten extremely overbought because of we had gotten below 4% of the 10-year Treasury yield, extremely overbought, and we were going to get a retracement in bond yields, and that's occurred. We've seen bond yields pick up here because of what's happening in the Middle East, et cetera. And these things happen. It's always interesting. It's like, when things get really overbought or oversold, everybody's like, well, why does that matter? It's like, well, because something always happens that causes that to reverse, right? And so when things are all kind of one-sided, something happens and then, market prices reverse and they get back to oversold. And it's been interesting to watch because we've been moving back up in yields, not dramatically, but have been moving back up in yields. And, if we still take a look at trueflation and some of the other things that are going on, it certainly suggests that yields are probably going to, after this rally of whatever there is, we get to 4.1, 4.2%, wherever we're going to get to before we're back to oversold on yields. It seems like that there's going to be this progressive trend, back towards being below 4%. If trueflation is right and inflation is declining and we're seeing some more of these deflationary pressures in the economy, we should see yields kind of hover around 4%-ish.
Yeah, I mean, look, if trueflation's right, yields are going to go down much more than, right? I mean, trueflation is below 1%. And I don't think trueflation is right in the absolute number, but I am very interested to see if it's right in the direction. Is inflation really going to start falling decently, rapidly over the next few months? And again, we may not even see that till March, right, because CPI lags real time by a few months. But yields have been in a general going down slightly ever since mid-year last year. And nothing goes in a straight line. We've had periods where yields have shot up, shot down, but bond volatility has been very low until the last few days. Recently, with the whole Iran conflict, yields have come down a little bit, not surprisingly, because we have higher oil prices. So you kind of rekindle that inflation concern. And this is going to cost the government a lot of money. So they're going to have to issue debt. The deficit is going to be higher than it would have been had we not gone into this conflict. So, I think the bond market is voicing a little concern. But we have CPI next Tuesday or Wednesday. We have employment tomorrow. Those things come in really, if employment comes in really weak and CPI kind of a tenth or two below expectations, I think we get back to where we were on bonds, a very constructive market with yields falling. A lot of days prior to Iran, where the market bonds would open down slightly and rally throughout the day. Very positive trading. But like you said, they got a little overdone. And, let them kind of get back to more fair value on a technical basis. Let the kind of economics, the true fundamentals of bonds take over once this Iran thing, it'll slowly start fading. Right. So, I think that's when bonds can kind of get back on their horse. And again, if trueflation's right, yields are going much lower. But if they're right in trend, that inflation's falling and it's going to fall at a decent clip, I think yields still can go decently lower from here.
All right. Thanks a lot, Mike. Appreciate it very much. That wraps up the show for the day. Be sure you buy the website. Be sure to like and subscribe to the channel. Give us that thumbs up on the channel. We certainly very much appreciate it. And get by the website, realinvestmentadvice.com. Mike's article is out talking about this kind of passive-aggressive market, which is where John Bogle's warning kind of ultimately came true. That article's on the website now. Newsletter out this weekend as well, so make sure you're subscribed, get that delivered to your inbox, and we will see you back here tomorrow for Financial Fitness Friday. Have a great day.